see whether I got $10,000 or not. What the?
Wow, Singlife dropped their interest rate from 2.5% to 2% following, I think, all the different savings accounts that dropped their interest rates. Is this gonna be the trend? Are all the saving accounts gonna just keep falling in interest rates? Well, today we're gonna talk about all of that and more. So we're gonna talk about falling interest rates, like why it's happening to the Singapore banks, and is it going to get worse? How long is this going to last? Like, what causes it? How long is it going to last? And more importantly, most importantly, as investors, entrepreneurs, what do we do about it, right? So stay tuned. Hey friends, welcome back to another video. My name is Gerald and I'm all about helping you make more money. So I talk about personal finance, investing, so that you can grow your pot of gold and really live meaningful lives and not be constrained by money. If this sounds good to you, be sure to hit that subscribe button and let's carry on. First up, let's talk about why this happens. Like why the Fed, US Fed actually suddenly reduced the interest rate. Of course, it happened because of COVID. So what happened is that COVID affected a lot of businesses. Businesses were forced to completely shut down, and business was just bad. It was just plain bad. Businesses were just dying. So as a result, the US Central Bank decided to reduce their interest rates to zero very quickly, and then that affected MAS, which in turn affected the Singapore banks. So everywhere started to kind of reduce their interest rates, like the Singlife savings account. So I want to start off by talking a little bit about what, how I used to save my money. I would go online and find the best deals and park your money there. And I remember a long time ago, I think CIMB was the best deal for students. 1% off, park all your money there. And that was before I knew about Singlife. And back then, I don't know how many of you remember, Standard Chartered used to send those SMSs and say, hey, if you top up fresh funds for the month of December or November, you get 1.9% increment of your interest rate. So you're wow, one whole month you transfer all your money there, and then next month you take them all back into your CIMB Fast Saver. And Singlife was a new level of a better deal, right? So things just got better. So it looks like we might have to go back to transferring the bulk of our cash to Standard Chartered again. So now the key question becomes so how does the US Central Bank action of reducing interest rates kind of affect Singapore banks, right? So this goes back to the economic trilemma. So in essence, the very simplified version is that every economy can choose 2 out of 3 monetary policies that they can use to kind of manage the funds in the country. So that's why it's a trilemma, right? So 3 parts, pick 2. So here's the thing about Singapore. Singapore chose fixed or exchange rate management. So we can manage our exchange rate to keep it stable, and we can also manage or have free capital flows into the country. And as a result, we basically lose our power to have monetary autonomy. And that is why we are very affected by monetary policies from China, from United States. And since United States is the biggest, the powerhouse in the world, that affects us directly. And that is why whenever the US Central Bank changes things, or the US Fed chairman says we're going to change things up, be on the lookout, because that affects us as Singaporeans. Alright, so now the point or the thing that we need to think about as investors is how does a huge drop in interest rate affect us as investors and entrepreneurs? So I think the first problem that I need to really talk about is the stimulation of the economy with so much money and extremely low interest rates. I think there's this problem of yield grabbing. So what I mean by yield grabbing is that people are used to getting returns of 6%, 7%, and that was when interest rates are much higher, right? So comparatively, that's an opportunity. But when everything fell, so does all your fixed deposits, your government bonds and all that sort. So when all these things fall, people are I'm used to the same, they are not used to their returns dropping so much. So what do? Is that they essentially try to maintain or reach up for the same level of returns by increasing their risk. So when people do that, essentially what they do is they move from less risky assets to a lot more risky assets. So there's a lot of money that moves out from like your savings account, your bonds, your government bonds, to riskier investing asset classes. So basically, the riskiest type of asset classes, risky type of asset class would be like your stocks and your properties. See the trend now? So all the money is like flowing into the stock market as well as the property in Singapore, and prices are like flying. So this yield grabbing problem is really dangerous, and it's compounded by robo advisors. So robo advisors, you set like your risk level and how much returns you want to target. And when government bonds are this low, what happens is that rebalancing occurs, and then more of your portfolio gets allocated to equities. So correct me if I'm wrong. I don't fully understand if this is how robo advisors work, but this is my understanding of where a lot of the money, one of the drivers that pushed a lot of the money into the stock market. So what can we learn from this? If we learn or look back at history, every time when this yield grabbing happens, the problem is that we deviate further and further from reality. So businesses are not earning more and more money, but the prices of the businesses, the value of them just kept flying. So the thing is that when you borrow money, eventually you have to return it. So if you are very far from reality, sometime or later something is going to pop and you fall back right into reality. You can't be living, technically you can for a long time, but eventually you have to fall back to reality. So what we have learned from history is that investors that have been yield grabbing in order to increase their returns took on a lot of risk, and when things popped, it is these unaware or not careful investors that didn't know what's going on, they were the ones that lost a lot of the money. So I don't want you to make the same mistake and lose all your money. So just take note on this yield grabbing phenomenon and make sure that you are not taking unnecessary risks just to reach out for more yields. But that being said, it is a time and it is an environment where interest rates are so low, people are just borrowing a lot of money to buy more houses because they are able to afford more, right? Their affordability increase, so they take on heavier loans. Companies likewise. So don't make that mistake of taking too much money. In fact, you should try and get $100 of free stock vouchers by putting your money inside Tiger Brokerage, the link that I have in the description box below. So now the question is, what can we do, and how long is this low interest rate environment going to last, right? So because that's what is going to really affect our investment decision. So let's look at how long this is going to last. So for this, we got to look at, I think Meet Kevin, recently he posted a video about the Fed's inflation rate updates, and I think that video accurately portrays like roughly how long the Fed or the US chairman intends to keep like interest rates low. So by his estimate, the summarized version is that it is going to be at least until 2024 to about 2026. So that's how long they're going to keep like a zero interest rate policy. And why? Or the key things to look out for is really the inflation rate in US. So basically, they want to keep inflation rate at 2%. Right now, they're falling really short of it. So if they can keep inflation rate at 2.5%, then it would happen a lot quicker. If they keep it at like 2.25, then interest rate would stay low for a much longer time. So that is really the key thing we need to look out for as investors. So if you want to check out the video, I'm going to leave it down in the description box below, so do check it out. And the next thing is, what can we do as investors? So I think there is really two train of thought. I like to put it as like, defensive investor according to Benjamin Graham, and enterprising investor. So basically, what differentiates one from another is how much time you are willing to put into investing. So if you are more of a passive guy, you don't take too much thinking about portfolio, I personally recommend or think the all-weather portfolio by Ray Dalio at this point in time looks like a very good option. Why? Because given the economic situation right now, I think protecting downsides is way more important than thinking, oh, I'm going to get like 20% next year. So if you're a passive investor, I think that's a good go-to strategy. So of course, all-weather portfolio does not perform as well as passively investing in the S&P 500, but in terms of downside, statistically, so much better. Like the downsides are so much less. So if you're near retiring and you want to protect your downside from a potential double dip recession, then I think the all-weather portfolio sounds like a good downside protection for a little less upside. So if you want to check out more about the all-weather portfolio, I think a local YouTuber, his name is Kevin Learns Investing. He talked about his thoughts on the all-weather portfolio. I'm going to leave his video down in the description below, so do check him out. And the next thing is for the enterprising investor. So if you're an enterprising investor, you're thinking, okay, I want to grab yield, I want to find opportunities. So for me, what I'm thinking is that because the interest rates, just fell to zero, people are starting to yield, grab, and find a lot of opportunities. And crisis hasn't really struck yet. So, I mean, of course, for those of you that have been severely affected by this COVID situation, I mean no offense, but on the business front, they have been very heavily propped up by government grants. So basically what I mean by that is that from a business side, right, because I run my own business, the government has been paying for you to employ people. Like they pay half your salaries of the staff. So what is people going to do? They're going to employ a lot of people, man, because your cost is down and you can drive up revenues very quickly at very low cost. But what happens when the grant money runs out next year? No more money for hiring people. Cost is going to just skyrocket. And margin's going to drop, revenue's going to drop. So people are going to fire people. Less people means less revenue drivers. So either cost goes up or revenue goes down a lot. So basically, it's very, very bad for businesses. In fact, some of the businesses that I know earn as much as twice the amount of money that they made last year because of government grants. So can you imagine how much impact or trauma is going to have to the job market next year when the grant money is just, whoop. I don't know. That's why I think, or personally, I feel that right now I'm just sitting mostly by the sides, trying to find the best deals to find loans, because I think when next year where things get really bad, if it does, that's when I really go heavy in bargain hunting. But right now I'm just looking at the opportunities and see what's out there. But prices are high right now. But I think, or I foresee that it will drop very significantly because of the job situation. So let me know what you think down in the comment section below. And now I'm going to talk about the quick updates that I have for my YouTube channel. So first up, I think is the Imran course. I think a lot of people have been asking for my update on Imran's course. The reason why I didn't immediately do a video on his course was because I wanted to have a 3 to 6 month kind of buffer to really analyze or give feedback on his after course review. So that's coming right up. So thank you guys for waiting. And I couldn't really post this because if I posted this, he saw it, he's gonna give me top-notch service, which is unfair, right? So that's why I kind of delayed posting this video. So now you understand the situation behind this. And now, also, I'm going to talk about the plans for this channel. I apologize, I haven't posted for a month, and that's because I just got married, as you can see. Because I recently started working in a job, I was thinking of drumming down my personal analysis, so I won't have that much of fancy editing like I do with my badminton channel. I wanted to make videos a lot nicer because I am very inspired by Andre Jake, but that's besides the point. Now I have to do very simple personal analysis because I'm pressed for time. So I hope you guys understand and let me know what you think, because if I make a mistake, do let me know, point it out where my analysis falls short so that I can learn. And in the meantime, if you haven't already, check out our Telegram group in the description. So I hope you found this video useful. Let me know what you think, and do check out my other videos if you haven't already. Check out what YouTube recommends you over here, or check out my playlist over here. I mean, that's it. I'll see you next time. Take care, friends.